Hello, folks. Brandon Chapman today. It's another edition of the TheoTrade video for Monday. What is today? November 28th, 2022. It's past turkey time. We're on our way to the end of the year. How is the market going to finish? The title of today's session is Recession Back on the Table? Energy traders seem to think so. And you look at the market today, we're down 1.5%. We're finishing basically the lows of the session. A lot of Fed speak today. Bullard out there, Williams out there, Deutsche Bank out there talking about downside potential to the market. We'll talk about that, plus potential option activity in energy stocks or ETFs rather, and UUP and AGNC today. But anyway, as we look at the market, we saw a little bit of shift on Friday. I guess it was, obviously it was a shortened trading day. We can see anomalous type behaviors, but the VIX was close to 20 down here, and all of a sudden the skew began to pop on Friday, closing at 128. Now, again, we might see that erode today. I was doing some pricing earlier on some spreads. Unfortunately, I deleted them, and it appears we'll probably be back down in the 115 to 120 range after it's today's close, and we get the data rolling in later today. And there's the bell, by the way. But it looks like we may come back in, but I like the fact we're starting to see some upward mobility. You think, man, why aren't institutions looking to hedge some of the risk that's out there? And of course, some of the risk was articulated by the Bullard, for example, today of the Fed. They need interest rates north of 5% into 2024. That blows away some of the expectations that the Fed may pivot middle of next year. Williams, another Fed head. Unemployment may exceed 5% to fight inflation. Then you got kind of the Brainerd scenario that says, others that have had raised rates hasn't exactly worked. She's been more the dove, but the point being is that we really don't know what the Fed's going to do, and they're likely going to err on the side of being tighter rather than looser, unless things begin to break economically. And is that what's about to happen? A lot of the data is kind of wishy-washy a little bit. We're going to get kind of a second print for GDP this week. We've got unemployment coming up on Friday. But right now, we've got to see maybe a serious uptick in unemployment before we're going to really start to see any traction on the Fed potentially cutting rates. Even the softer than expected inflation numbers of this month weren't exactly cool. They're hot, just less hot than expected. And so there's a lot of pressure. We are going to get the Fed. They're going to expected to raise rates on December 14th, and then we'll see what kind of discussion or talk comes out of it. What Powell says at the press conference, and maybe things change and leads to maybe an end of year liftoff. But the fact of the matter is, when you look at companies and earnings season, about 70% of companies have beat analyst estimates for earnings. I think 67% for revenue. So it's been a pretty good earnings season. We've seen a lot of companies guide lower. Obviously, Target took it on the nose with its big decline, really forecasting some major weakness on the consumer front. And so this is what we've got to see going forward, is that does the consumer materially break? And that's in essence what Powell said in his press conference a couple weeks ago, is basically they need to cool off the consumer. And certainly there's anecdotally just information coming out regarding savings on decline. We're not seeing, checking deposits increase with savings. It appears people are spending. People are putting stuff on cards and keeping balances. A major trend change from what we've seen over the last couple of years. And going into next year, could the recession be back on the table again? And I think absolutely. And what we're seeing in energy today. So let's look at forward/CL. Energy was, oil itself was flat on the session, up 0.6%, not a lot given the volatility it's seen here. Let's add a key level around that 75 mark. So sometimes you can get caught up looking at the price of crude, which is a daisy chain of various contracts. What's better is to look at the curve. So we're looking at oil futures into the future, right? So we're seeing right here, for example, January, February, and so forth. What you're seeing, and this is a change, from example, from the end of September and early October, where the curve was this way, right? What you're seeing is right now is we're very, very flat. Basically, what's happening right now is that the premium All right. The net cost of carry that was positive here is basically flat. What we're seeing is we may be moving into more of a normal kind of an S curve for this compared to a backwardation. So we're not in contango. We're not even necessarily normal, but we are flat. And you got to go through a flat phase before you can go to contango or even kind of a normal kind of S curve with this. What this is reflecting is the potential we could start to see demand destruction going into next year for oil. There's not the implied shortage that was priced in previously. While oil prices today held in there, we've got inventory coming up this week. But what we are seeing is stuff that's more forward looking, like XLE, for example. Stocks look forward more so than commodities do. Commodities tend to run into the brick wall. But with XLE down 2.7% today, the second worst performing sector on the day, the worst being XLRE, real estate. And we're going to look at a real estate mortgage REIT here in today's session as well. But what you're seeing is a little bit of weakness. And we see support down here at about 88. That starts to break way. We are looking at a retracement of this uptrend. 85, 81 and a half, 80. We're back at the same levels we saw retracing this way. But again, you get the point. We could readily see energy stocks retrace back to 79. But what if this is a recession? We may see things even much bigger to the downside here if we start to see demand cool. Now, I don't expect this curve to go to contango. I'm not expecting that we're going to be awash with supply unless something really crazy happened. But again, what we are seeing is the transition and expectations with energy near previous highs. As you know, I've been pretty bullish on energy. Recently cooled off a bit, but back here we looked at bullet energy stuff and talked about being long energy back here. But the idea is that right now we might be looking at some downside. So looking to take profits in energy, reducing exposure, whatever, rolling if you have long options, etc., may help mitigate some of the risks to the downside. What we saw today in trade, option trade specifically, there was a decent sized trade down here. If you look in the option time and sales, it's a December expiration here, 75. What do you got? Now we'll come over and look at it. There's more in there that meets the eye. This is transformed. Anyway, so we look at 30 December. So I was looking at the wrong expiration. That's why. But you look in here, right? This out of the money 70 strike. Basically, this is being closed out and rolled up to the 78. And again, what are we doing here? We're taking a put that was put placed previously, and they're rolling it up closer to the stock price. They're doing it at a debit, at a cost, trying to capture what they can here, trying to have something that's more connected with the stock price. 78 gets you to about a 2/3 retracement right here. I think if we break support up here, we could readily end up potentially going to 78-ish in the ensuing weeks here. Again, that's relatively short to 30 December, but that gives you about 32 days for it to work down to 78 as a target. So again, gives you a target and kind of a time frame for that to happen. Another one's ERX. This one you don't see a lot, but again, Energy Trust coming here, bull 2 timeshares. Really not a need to trade these products from an option standpoint, but again, you can use it from a sentiment perspective. But today it was the December expiration of this one. Out of the money here, 4,500 contracts. Again, 20-cent spread here. You'd probably trade something like XLE, do a spread trade on that, particularly since we're looking at the downside here. But again, just from a sentiment standpoint, some long interest coming in here. 74% at the ask there. So buying activity in ERX, and the strike price again is 69, which is about at the money. But if we start to break, this may help accelerate the downside here in ERX. XOP, again, oil and gas producers, exploration, right? Again, support level right here at around 148. We look at today's trade at XOP. I mean, not huge, but this is a 9 December, very short dated expiration here. Buying the 145, selling the 135. So again, 135 gets you here. We draw the fib retracement. That's about a 61% retracement. So again, not unusual to see a retracement back to these levels right here. And you're seeing some trade today kind of echoing that sentiment. And when you look at Buller talking about the Fed funds rate 5% or higher into 2024, We're talking Williams projecting a 5% unemployment rate to fight inflation. It certainly looks like recession is definitely on the table and palatable if you're a Fed head or given today's Fed speak. So I thought that was interesting. And what we didn't see much movement in interest rates, right? The 10-year Treasury yield basically up a third of a point, nothing big there. However, the dollar did rally today, up about 0.73%. And that's certainly going to put pressure on the S&P. Maybe half of the 1.57% decline might be contributed to the dollar strength. And all you got to do is to help confirm that is look at gold. And gold was also down today about 0.75 of a point. So it really looked like maybe half of today's move in the S&P had more to do with dollar strength leading to S&P weakness. Now, why would that happen? It's because if I look at SPY or SPX or ES, whatever you're looking at in terms of the product, these are priced in dollars. So if the dollar strengthens by two-thirds of a point, 3/4 of a point rather, this should weaken by 3/4 of a point, all things being equal. But obviously we saw more weakness extending today because of energy and real estate. And we've got some real estate data coming up on the week as well. But anyway, I thought that was intriguing. Again, dollar strength, pressuring stocks. And one of the things I've been watching for in the volatility markets is the VIX. On Friday, the VIX came close to 20. And what I was hoping to see with the VIX at 20, I was hoping to see skew pop to about 130. Didn't exactly happen. We may back off, as I mentioned, from our 130 highs here. But again, I do think it's interesting as you look at the product depth on the /VX. What you're seeing as you look at these two contracts here, December and January, if you do a similar kind of VIX formula, you're going to come up with something in the over 26. And with the VIX right now, if you go back to the charts here, VIX at 22, we are pricing in almost a 20% higher VIX price compared to the spot VIX here at 22. And that's indicating expectations of future volatility. Now, what does that mean here, right? As we go back to the S&P, this is really just reflecting the possibility we could see a decline here. As we look at the upside, is it 4,200? Is it even 4,300? Maybe. It might just be 4,050. But what's the downside here? 3,500 seems pretty reasonable if we look over the next couple of months, going into the first part of next year. So we're talking about as limited upside, more downside. We're talking about skew. While that's kind of reflected on the skew index as of last Friday, we may see that walk back. But I think that's becoming apparent that we could have an end-of-year rally at some point. I do think we'll probably end up picking up quickly in here. If we break support, we're probably looking to go lower. But I'm expecting to kind of rally back up again, retest that 40-50 area, and then we'll see what we got going into the end of the year. And I think the first part of next year could be very difficult with gold leading the market, with potentially a weaker dollar. Initially, gold leading the S&P, which it's kind of done up until recently, and maybe a gold rally end of year going to early part of next year. But I think with the stronger dollar, we may have further pressure to go here. And that leads us to the dollar. Now, this is the dollar index in UUP. It's an ETF. Now, we're seeing strength today. We're forming support here at the similar area. Again, stronger dollar should contribute to a weaker stock market. And as we look at today in UUP, bearish activity on the, sorry, it's like I got an eagle over my hands. Stop playing the pen. Anyway, December, 31,000 contracts right here, mostly bought at the 29. And if you come down, look at time and sales, you'll kind of see a lot of this activity, really large prints being bought at 25 cents, around the 735, 736, 737. That's mountain time this morning. And so again, you think about the upside here, 29's right at this level. We start to take out 29. Could we push towards 20 and a half, maybe, 29.65, maybe 30 and a half going to the end of the year? If we see a rally like that, that's going to mean the market's selling off, very likely going to the end of the year. Gold will be weak. Maybe just get up to 30, again, 29, 29 and a half and roll over. That's the end of year rally scenario, the Santa Claus rally. The last week between Christmas and New Year's, weaker dollar would help contribute to that upside potential. So again, some bullish trade in UUP today. pointing to the fact we may see a little bit of near-term pressure. The market may have trouble getting out of this box that it's in here. Maybe retest 39.10 en route to retest and maybe 40.25, and then we'll see where we go from there headed into the end of the year. Finally, we're going to wrap things up with AGNC. AGNC is interesting. It's a REIT. It's a mortgage REIT, heavily leveraged. If interest rates stay high for long, this is not going to be good for the housing industry. And for a company that owns mortgages, especially not good. Now, new stuff that's being originated does have a higher return, but what about all the stuff that they've bought? And then you start to have redemptions potentially, and you can see how it might exacerbate their problems that they largely have a lot of lower yielding mortgage bonds. They're not going to refinance at higher rates, that kind of stuff. And then there's the potential for default coming up next year if unemployment starts to increase. So today we're seeing a little bit of weakness, despite the fact not a lot of movement in treasuries, but this is when we saw some bearishness in NLY last week, which is kind of a similar company, NLY here. We're retesting our prior highs there. But AGNC today, we're seeing another stab at the downside here in AGNC. This is a January expiration. It's at the $9 strike price, mostly bought there. Now, again, the good thing about the skew is that you can construct a spread. In this case, a 9 and 8 cost you about 19 cents there for 1 point. So you got over a 4-to-1 reward to risk if we can get to $8 right here in the next 53 days. If we get below that sooner, it opens the upside. Others might say, well, yeah, I'll just gamble on a $34 contract in lieu of the fact this maybe sells off really hard, maybe to 7, and I've got $2 of upside minus my 34 cents I'm putting in. So whatever tact you take, it does benefit here because you can construct spreads like a 10 and a 9 or a 10 and an 8, where you're getting a little bit of premium on these out of the money options. But a bearish trade in here, constructing the spread, will allow you to ride out the storm a little bit in lieu of a drop later in this 53-day cycle that are on those options. But again, a significant trade today in AGNC pointing to downside expectations. So again, I think right now, be wary of the downside. Again, I think we'll probably end up picking up near support here. May have a chance of retesting our highs, and then we'll see where we go. Does the VIX hold up at a low levels near 22 as we kind of decline in here? Does the dollar strength likely drive down the market in the near term? And then on the rally, do we start to see the skew increase? That's what I'm watching for, because it makes sense on a day like today. Skew should decline. The downside risk starts to come off the table. The VIX is higher as they're selling stock. But again, I'm looking for the reset here. So watch the next coming days, probably see some downside. But the bigger picture perspective is the fact that the upside in the next, let's say, month versus the downside potential in the next, so we'll say 2 to 3 months. The upside potential next 2 to 3 months does not really balance out the downside potential in the next 2 to 3 months. So definitely a time to be careful. You can try to find opportunities in this end of year period in the last month of December, but just be careful. This is a time, if you've made a little money here, you probably want to take some profits off the table. Anyway, with that in mind, we'll catch you back to next week on the video. Have a great one. Thank you.